Thanks for listening to Mike Douglas, Michigan's retirement coach.
When you think about investment risk, most think about the stock market crashes, volatility, and seeing account balances move up and down. But some of the biggest threats to your retirement aren't even the risks that you see on a statement. In reality, retirees face a variety of risks that have nothing to do with the market correction. Think about inflation. It can really quietly erode your purchasing power. You can have too much cash, and that can limit your future growth. Bonds can lose value when interest rates go up. And living longer than expected can put pressure on a retirement plan that wasn't built to last. Today, we're looking at why some investments feel safe on the surface and then they create risks of their own, and why true investment safety should be measured by your ability to achieve your retirement goals. The problem with defining safe too narrowly, many investors define safety as avoiding market volatility, but that's only one type of investment risk. Most people think safe means an investment that won't fluctuate on value. Really, market volatility gets the most attention because it's visible and immediate. Retirement planning involves multiple risks, not just stock market risk. A portfolio that never experiences volatility can still fail to meet your retirement objectives and goals. True safety should be measured by whether your investments help support your long-term retirement goals and the life you want to live. Avoiding one risk can sometimes increase exposure to other risks. Once investors start looking beyond stock market volatility, they start to discover that one of the biggest retirement risks is hiding right in plain sight. It's not a market crash. It's the gradual loss of your purchasing power that can occur year after year, often without attracting much attention at all. It's that slow leak in the bottom of the bucket. Inflation risk and the hidden cost of cash. Money that's protected from market volatility can still lose value over time because of inflation. Inflation reduces what your money can buy over time. Retirees often face decades of rising costs during their retirement. Large cash positions can create a really false sense of security. If we're sitting really cash heavy, I think I'm good. I've got safety, but yet the groceries keep getting more expensive. Gas keeps going up and you have the same amount of cash. While cash can preserve principal, it may not preserve your purchasing power. Even moderate inflation can have a significant impact over the next 20 to 30 years of retirement. Retirees need to really evaluate whether your portfolio has enough growth potential to outpace inflation. If cash isn't completely risk-free, what about bonds? Many people think, especially retirees, I'm going to turn to bonds for stability and income, and then they can play a really important role in my retirement portfolio. But bonds have risks of their own that investors sometimes overlook. We like to think of bonds as the yang to the yin. If my stocks go up, my bonds go down. But when my stocks go down, my bonds go up. But what happens when interest rates go up? Understanding the interest rate risk and longevity, even traditionally conservative investments come with trade-offs. Bond prices and interest rates often move in opposite direction. Rising interest rates can reduce the value of existing bond holdings. Not all bonds carry the same level of risk. Investors, we need to understand what duration, credit quality, and interest rate sensitivity the bonds have. Another major investment risk in your retirement is longevity risk. Many retirees will spend 20 or 30 years in retirement. That's a long time. A portfolio is designed for a short retirement could really struggle if you retire and live longer, right? If you build out a plan for 10 years and you live 30, that's a problem. I met with someone one time and literally their retirement plan was 5 years. They said, we don't want to look more than 5 years out. I said, what if you die way beyond that? And just as a funny way to open up our eyes to life's long and make sure your money lives longer. Retirement planning should account for the possibility that you live well into your 80s or 90s, maybe even 100. When investors focus exclusively on avoiding losses, they can unintentionally create another problem. Your desire to avoid risk can become so strong that you miss out on the growth opportunities the retirement plan still may need down the road. The opportunity cost of playing it too safe. Eliminating volatility out of your portfolio is not the same thing as building a successful retirement plan. Many retirees reduce stock exposure really dramatically. Why? Because it feels safer. I don't have as much risk. I just don't want to see my investments go down. We get it. But at the same time, your growth assets may still play a really important role during your retirement. Retirement can last decades, and you need to create a portfolio that fulfills that ongoing need for growth. Avoiding growth entirely can really increase the likelihood that you may run out of money in retirement or have to reduce your income. Volatility risk and retirement planning risk are not the same thing. A portfolio should be really closely evaluated based on its ability to support your long-term retirement goals, not just short-term fluctuations, and not just what that advisor or stockbroker, right, is just doing for everybody. What does your family want, and how do you want to live? Make sure that portfolio is built for that. The challenge is finding the right balance between preservation, income, and growth. The good news is this: identifying these risks is often the first step towards managing them. If we don't know what we're doing and we don't realize there's something going on, how would we fix it? Well, I'm telling you, here's what we got to work on. Retirement investing isn't about eliminating every possible risk. It's about understanding the different risks you face and building a strategy to balance them appropriately. Listen, here's your action items. Review how much of your portfolio is currently held in cash. Evaluate whether your investments have enough growth potential to address inflation. Understand the role bonds play in your portfolio and the risks that those bonds actually do still carry. Consider how long your retirement realistically may last. Look beyond market volatility when you're evaluating my investment risk. What do I have in my portfolio? Don't just look at the stock markets up and down. There's other risks we have to factor in. Finally, review whether your current investment strategy aligns with your retirement goals. Guys, when it comes to retirement investing, safety isn't as simple as just avoiding stocks or eliminating volatility. Every investment choice you make involves trade-offs, and some of the risks that matter most to retirees are the ones that receive the least attention. A truly effective retirement strategy doesn't focus on avoiding one specific risk. It seeks to balance inflation risk, longevity risk, market risk, and income needs in a way that supports your long-term goals. Again, yours, not the financial institution, not the big box broker, not the stock picker, your retirement goals. If you need a risk review of your retirement savings, just reach out to us. Go to our website, michigansretirementcoach.com, or click on the links that we've posted right here.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit michigansretirementcoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.